Welcome, FPS 705 class, to the second online lecture of Valuations. Ordinarily, this slide deck would be done in one sitting with you in class. However, as a result of us migrating to an online setting as a result of COVID-19, I'm going to be splitting this video into separate components, each component addressing individually a unique methodology in relation to the value of equity. The reason why I'm going to do this is so that at a later stage, if there are any fundamental principles you wish to review, you can go to the relevant video which is applicable. That being said, in this set of videos, video set 2, we're going to be looking at various multiples and dividend approaches relating specifically to the valuation of equity. However, before we move forward, let's remember what we did last year in FPS 300 basis. When we thought about how we valued equity in the last year, we used what was known as an earnings multiple or an earnings-based valuation. In this particular valuation, we would take a comparable company's multiple, either the price earnings or the earnings yield, and we would multiply that by the maintainable earnings. And we can see this formula shown on the screen. So the steps that we followed when we went through this process, number one is we need to determine the maintainable earnings. In determining the maintainable earnings, we looked for a trend. If a trend existed and it was upward seeking, then we would take last year's figure and we would use that as a base. We would then, on last year's figures, make certain adjustments to adjust for extraordinary once-off items, expenses that were overstated as a result of once-off exceptions. We made corrections to material mistakes, and then we made changes to accounting policies. This then got us to a maintainable earnings figure that we used to multiply a comparable PE, which was the second step in our process. If we're thinking about what we needed to do in the second step, the first part was identifying a comparable company. All right, this company would hopefully be in the same industry and hopefully of a similar size that was listed. We would take their earnings multiple and then we would adjust for known differences between that particular company that we've taken the multiple from and the company that we are trying to value. And we'd adjust for risk and growth prospects. All right, the big thing about this is that we knew when we'd made these adjustments that they were subjective. And that's just a very high level recap on the earnings-based valuation from last year. So building on this particular concept, when we're looking at FPS 705 and an earnings-based approach, which is the first approach we're going to introduce you to, we've got two different multiples as last year that we can use. Number one, we can use a price earnings multiple, or we can use an earnings yield multiple. If we're using an earnings yield, we've got to divide my maintainable earnings by the earnings yield to get my value of equity. And if I'm using a price earnings multiple, I must multiply my maintainable earnings to get my overall value of equity. And you'll recall last year we went through that exercise where we back solved looking at these various formulas as to why we multiply and divide. Now, in other words, the only thing that we're searching for is this value of equity that we have as part of the calculation. In other words, P0 in my respective computations. However, building on this at FPS 705, there's a unique distinction that we need to make. And that being that there's more than one type of multiple approach. And what we need to look at is we need to realize that there is a trailing, a current, and a forward multiple that we can use. Historically, what we have been using is we've been looking at just a trailing or a historic PE multiple. In other words, what we did was we looked at what were the historical trends, what happened for the last 3 years, and then we based my value in the future on the historical results from the prior 3 years. But if we take a step back and we think about it, there's an inherent problem in this, isn't there? Because how do we know that what happens in the future is going to be based on what happens in the past. Which brings us to a current PE multiple. When we're looking at a current PE multiple, we take the maintainable earnings based on the current period. In other words, the current year results. So if you're thinking about it and you're now halfway through the year, you have now got a forecast for 6 months, or you've got an actual result for 6 months. You can then forecast the remaining 6 months of the year to be able to get a current earnings figure. That's what the earnings is presently in that particular company, and we can use that to determine a current PE multiple and a current earnings approach. The last different kind of multiple that we have, and probably the most value seeking or the most value creating from an earnings based approach, is going to be a forward PE multiple. When we're looking at a forward PE multiple, we are forecasting in the next year or the next 2 years the financial results. As a result of going through this thorough forecasting process, we then can base the valuation that we determine for the earnings on my future maintainable earnings. Therefore, we eliminate the problem that we have with that historic. Why? Because the value is no longer going to be based on historical figures, it's now going to be based on forecasted figures that happen in the future. So the distinction that I just want to make on this slide when we're looking at an earnings approach is that we must identify that there are different types: the trailing or historic, current, and the forward. Let's have a look at a quick example. In this particular example, we start off with determining how to calculate a historical PE. Now, this is something that you all would have been familiar with and you all would have been exposed to previously. So in this example, we have got available at the end of last year, the 31st of December 2019, and we've got an earnings per share of 12 Rand and a market price of 120 Rand per share. That means that simply my price earnings ratio, 120 divided by 12, gives me 10. That would represent my historic PE ratio. Why? Because it's based on historical information. I'm now in the 2020 financial year. The question we now need to go is, well, how do we calculate a forward price earnings multiple? So we've still got that same information at last year's end. We've got 120 as my market price. We've got the earnings per share historically at 12 Rand. And we have got my forecasted for the financial year 2020 at 13 Rand 20. With this information, I now need to determine what my forward price earnings multiple is going to be. So what I need to do is I need to be able to determine how to convert my price earnings historical into a price earnings forward. And quite simply, I just need to discount 1 year's future growth out of my historical price earnings multiple. How do I do that? I take my future value, in other words, what is my historical PE, and I plug that into my financial calculator as my future value. I have to discount by 1 year, so n is equal to 1, and then I determine what is my growth in that last year. Well, in this example, I've got my forecasted as 13 Rand 20, I've got my historic as 12, so the growth in my earnings is 10%. 13.2 minus 12 divided by 12. So my growth is 10%. I then input and I determine what my present value is, and I get a PE forward of 9.09. What does this mean? And what am I trying to show? When I'm looking at my forward PE will always be lower than my historical price earnings. Taking this new bit of information and applying it to my earnings approach, using either an earnings yield or an earning multiple, I get to a situation where I can use my historic, current, or forward PE multiple and then adjust for my risk and growth factors to get to my PE multiple that represents that of the company. I then multiply that by my maintainable earnings to get the value of my equity. When I'm looking at my earnings yield, which is simply the inverse of my historic PE, as we did last year in FBS 300, I'll again add or minus my risk adjustments and growth adjustments to get me to my earnings yield. Maintainable earnings divided by my earnings yield gets me to my final value. What I can also use is I can also use the cost of equity in order to value my particular equity. So I take the cost of equity of a similar company, adjust for risk factors. In other words, I can also just use a beta of a similar company. That gives me my risk-adjusted cost of equity less my company-specific growth factor. I can now take this cost of equity that I have that represents that of the company, deduct my future growth prospects, and multiply by my dividend cover, which gets me to my forward-looking PE multiple. So that's just another derivation to determining an earnings-based approach. Looking at my maintainable earnings, what we need to highlight, and what I need to highlight from this side, we've spoken about the adjustments and the adjustments that we need to make. In other words, market-related factors, once-off items, abnormal items, change in accounting policies. What if we throw in a change in accounting policy as a result of the incorporation of the new leases standard? How does that impact? Well, if I'm using historical data, there's going to be some point in time where it's on operating lease and now it's got to be capitalized onto the financial statements. What change does that make to my income statement? What adjustments do I need to make? Because it's going to impact on my historical amount and therefore impact on my trend that I show. But the reason why I want to incorporate this concept into the slide is that I need to make sure that I always use like for like. When I'm using my maintainable earnings, I've got to use a like-for-like maintainable earnings with a like-for-like earnings multiple. So, for instance, when I'm looking at a historical PE ratio, I've got to use a maintainable historical earnings. In other words, I've got to look at my earnings at that particular point in time. When I'm looking at my forward multiple, I've got to use my forward-looking maintainable earnings. And when I'm looking at my current PE multiple, I've got to look at my current earnings in the current year, grossed up to account for the entire year's worth of earnings to determine that particular value. So the main concept that we want to look at here is compare like for like. All right, that brings us to the end of our first little video relating to earnings and using earnings-based multiples to determine the value of equity. All right, doesn't take too long to say goodbye. I'll see you shortly for the next video. Cheers.